Section 3 of Becoming a Trader course. We're going to dive into the trading vocabulary so you kind of understand when I'm explaining things, everything I'm talking about, and it'll make things easier to quickly identify stuff in the chart. You know what to label, and what you're looking for is what it's called, and it'll just make everything more simpler once you know that, because then I can freely talk and we'll be able to understand each other. So a quick example: pips, lot sizes, margin, leverage, and stop loss orders. I've already used those in the past, but that's just an example of what we're going to dive into just to make sure you really do understand everything. Let's go over all the basic ones right now and break them down. So this picture right here, we have the bid and ask spread. So the difference between the highest price a buyer is willing to pay for an asset, which is the bid, and the lowest price a seller is willing to accept, and that's the ask. So you can see we have the bid, we have the ask. Well, what's the spread? That is the difference. So if someone, say they're selling a stock for $1, but people want to pay 90 cents, well, there's a 10 cents gap, and you might not get filled if you don't come up to the ask, and vice versa. Now, if you do a market order, you're going to get filled in wherever there is something to sell you at that price. So that's, for example, if the price on the charts was showing, I don't know, 98 cents, and you hit market order, you might get filled in at that dollar that that seller is selling at. So if you want a specific price, that's when you're going to be putting in your limit orders and stop orders, so you get that price and you don't get filled in at a different price. The spreads are also sometimes how, or most of the time, how the brokers are making their money. They'll put an extra spread in there, even though it's not really the bid and ask. They might say it's the bid and ask, and they'll click their little bit of profit right there, right off the bat. Next, we go into leverage. We already covered that, but I just want to go over all these definitions so you understand, and you also have a reference to come back to and look up these definitions. So leverage, the use of borrowed capital to increase the potential return on an investment, or it could go against you. You could lose more quicker if you use too much leverage. Margin is the amount of money required to open and maintain a leveraged position. So if you over leveraged and a trade is going against you and you got no margin left, you're going to get margin called. They're going to close out your trade, and they're going to take what money you do have before you lose more than you have. Stop loss, we also went over these, but stop loss is an order placed to sell an asset at a predetermined price in an order to limit potential losses. Now, pips, these are used in Forex, the smallest unit of price movement in the Forex market. And lots, or what we would say is lot size, are you going to take one lot size or two? It's a standardized trading size used in the Forex market, and it was the 100,000, right? So when you're starting out and you have a smaller account, you'll be taking 0.1 of a lot. So you would cut back to a 10,000 instead of 100,000. Then we have long and short positions. Positioned open with the expectation that the price of an asset will rise. That's a long position. And then the reversed is a short position. You want it to fall. Spread, as pictured over there, that is the difference between the bid and the ask. Equity, the value of an account's asset minus its liabilities. So I don't have an example. Actually, I could pull up TradingView. Let's open up paper trading. So you'll see the equity here and the account balance, right? But let me open a trade real quick. Why is this so high? How do I? Where's the? You have to keep it that high? What? There we go. Okay, that was. I don't know why the little drag bar wasn't there. I guess I opened it full size. I don't know. So let me open a trade real quick. We're gonna hit just buy. Oh, not 10. Let's buy one real quick. And then look, since I'm down $12.50, my equity is $146,000. $0.78. My account balance was at 90.50, but because I have a trade open and we lost 12, that is my equity. And well, now we're break even, so I'm gonna close this. And I lost $3 because I did in your settings. I'll show you real quick. It's a little advanced, but you go to your commission settings. I just put $3.50 as the flat commission. All right, now that we covered that, liquidity is the ability of an asset to be bought or sold quickly without affecting its price. Liquidity is your friend, and we'll dive into this later on in the course and in the advanced course. But liquidity, you're going to hear a lot of coming in the future. And then lastly, volatility, a measure of the amount of price movement of an asset over a certain period of time. And that's basically volatility would be those big runs in prices, high volatility, or if price goes one way and then comes back the other way, that as well. And that's usually happens in big news events. Just going over these one more time, we got market orders, limit orders, stop orders, and trailing stop orders. If you don't remember or some reason you skipped over our past video when we broke this down, go into that video. I'm just going to quickly run through these definitions for you. Market orders, these are orders to buy or sell a currency or future contract at the current market price. Market orders are executed immediately. Limit orders. These are orders to buy or sell a currency or future contract at a specific price or better. A buy limit order is placed below current price, while a sell limit is placed above it. Limit orders are used to enter a market at a specific price level. And stop orders. These are orders to buy or sell a currency or future contract at a specific price or worse. A buy stop is placed above the current market, and a sell stop is placed below it. Stop orders are used to limit losses or to enter a market after a breakout has occurred. So if you're a breakout trader, you'll be using stops. And if you're waiting to get for a pullback and you want to get in on those trades, you'll be using limit orders. Trailing stop orders, I used to use them, but I don't really swing trade anymore. So I don't really have a reason to do a trailing stop, and I just manually manage risk anyways nowadays. But basically, you could set a stop loss of 10, 15 pips in the Forex market, for example. And every time price goes up 5 pips, your stop loss comes with it. So you're locking in profit as price keeps going. So if you think you're on a big run and it's going to run for, I don't know, if you're swinging maybe weeks, maybe even a month, you're just on a real bullish run, setting up a stop loss or something like that would be something that would get you in and keep running that ride. But with how market likes to whip back and forth right now, it doesn't really work. It'll stop you out and then keep going. And you don't really want to put a big trailing stop because you're just going to lose money. So right now I just manually manage my risk on everything. And most of my trades I'm done within 15, 20 minutes anyways.